For many, investing is all about saving money for longer term goals. But how easy is it to make money regularly from the stock market? Welcome to Which Money. I'm Lucia Ariano, and with me today, I'm joined by Which senior data journalist Josh Wilson
Pleasure as always.
and the head of investment analysis at AJ Bell, Laith Khalaf. Hello, Laith.
Hello, everyone.
Thank you both so much for joining us today. Now, shall we start from the top? Josh, can you explain exactly what we're talking about here? It's going to be a deep dive into dividends, right?
Yes, that's right. So just very quickly to explain it, what we're talking about here is passive income. And normally what we mean by investing for passive income is investing either into firms or into funds, which when it's with firms, you invest into it and then they pay you a dividend back, usually twice a year. With a fund, you might invest into what's known as a passive income fund, and that fund will specialize in investing into a basket of firms. And that basket of firms, they'll be known for paying dividend income. So you can expect to get that, again, usually twice a year, and that's how you would build up your investment portfolio.
Mm-hmm. And Laith, is the general view that, there's a lot of money to be made here, but is it more for the adventurous?
I guess so. I guess it depends what your jumping off point is. A lot of people, obviously, in the UK feel very comfortable with cash. We've got a lot of people holding huge amounts of cash at the moment, which potentially they should really be investing because while you can get a reasonable interest rate on cash at the moment, you can get a reasonable yield by investing in the stock market and also hopefully some longer term growth. And if you look at historical figures over the longer terms, shares beat cash. But having said that, for some people, it probably does feel like a risky endeavor. I guess we don't often talk about the risks of cash, which are that interest rates fall, you're getting less money than the rate of inflation, which, given that inflation is creeping up, is kind of a real risk at the moment. So any personal finance plan should really incorporate both cash and investing, so some safer stuff and some riskier stuff. And probably at the moment in the UK, the balance is more towards the safer stuff. Even the financial regulator, the FCA, is actually looking at trying to get people to invest more because they're sitting on big piles of cash. And actually, that could be more productively employed in the stock market, from their personal situation, because that opens up potential for longer term returns for them. But also economically, that's a better thing for them to be doing because it means investing in firms and businesses and providing them with capital too.
Mm-hmm. And while we're here, then, just to provide some context, what are we talking about when you say the safer stuff? What kind of thing do you mean?
Well, I mean, the safer stuff is cash. So cash savings accounts are obviously very popular. Cash ISAs are very, very popular. And these are things that you are probably very familiar with because you get them from a bank, which is someone you're used to dealing with. And so those are the kind of accounts where people obviously have some money, and there's definitely a place for those in any financial planning portfolio because you must have some money in cash, which you can get at to pay for emergencies. For instance, if you lose your job, you need money to cover expenses. You might have, your boiler breaks down, for instance. You need money to cover that. So the problem with investing is it's good in the long term because you get years when the market goes down and years when it goes up, both very strongly potentially. So over the long term, you get better long-term returns than from cash. But the problem is over any 1 year, you can get downdrafts where your money could fall by, for instance, 20% in we've seen in the past. And that kind of level obviously means that if you put £5,000 aside for a new boiler and the market drops £4,000, you can't pay for that boiler anymore. Whereas in cash, you do have that safety. But as I say, at the moment in the UK, a lot of people are holding cash and large sums of cash. So general financial planning rule of thumb is that you should look to have a cash buffer of somewhere in the region of 3 to 6 months of expenses to cover you, for any lump sum items or if you lose your job. But lots of people are holding sums much bigger than that in cash, partly probably because they're familiar with it, partly because it feels safe, and partly because perhaps they haven't considered investing yet.
Okay, so let's say you're listening and you have this buffer. What kind of companies, if we're talking about dividends, what kind of companies might you be thinking about investing in? Shall we start with, the first one that comes to mind probably for a lot of people is the FTSE 100. Is this a reliable dividend payer, Josh?
So the FTSE 100 is the 100 of the 100 biggest firms on the UK stock market. The FTSE has a bit of a reputation for being quite a reliable dividend payer. And what I mean when I say that is that the companies listed on the FTSE 100 have quite a long history, not all of them, but a lot of them, of consistently paying out dividends to their shareholders. Now, for example, last year was a really good one for dividends from UK companies. So firms in the UK dished out £90 billion worth of dividends to shareholders, which is a massive amount. And these were heavily concentrated within the FTSE 100, particularly the banking sector. So the banking sector and also the energy sector and the oil majors are some of the firms that make up these sectors are again very well known for paying out like pretty bumper dividends. So some examples of firms that tend to pay quite large dividends from the FTSE 100 would be like HSBC, Lloyds, BP, Shell. These all have a pretty consistent history of paying out fairly consistent dividends, fairly large dividends.
And what about, looking outside of the UK, the US, Europe, other global markets, Laith?
Yeah, I mean, you can invest in other global markets. The issue, I think, is that if you do that, you get a more diversified portfolio. It's definitely worth considering doing, but you do tend to have to accept a lower dividend yield. So in the UK, a normal kind of income fund, you can probably expect somewhere in the region of 3.5% to 4% as a yield. You go across to the US, for instance, you're probably looking in the region of somewhere around 2%, maybe not even that. So it's a very different market to look at. So one of the things that you might get from the US, which we've definitely seen in recent years, is more capital growth. So that actually, your income is less, but there are a lot of big companies out there that are growing very fast, and as a result, we've seen capital values rise considerably. If you look over the last 10 years, considerably more than the UK, even with dividends invested. So probably a diversified portfolio has a range of these different approaches, but if you are very focused on income, then the UK is actually a pretty fertile hunting ground for that.
Yeah, and I'd also add to that, which is some really good points there, that make sure you do your research before you invest as well. Like invest into, if you're investing in firms, look at the firms. If you're invested in funds, look at the funds and their returns. So there are some things you can do for spotting a reliable dividend paying firm. One of the most important things to look at is the yield, which is how much a firm pays out relative to its share price in dividends. So that'll give you an idea of how much you can expect to get back from the dividend. You also want to take a look at the cover ratio, and this shows how affordable the dividend is for the firm, which is quite important because you don't necessarily want to be investing into a firm that's paying out, like, let's say, all of its profits and also putting itself into debt, let's say, to pay out a dividend, because that wouldn't be sustainable for the firm. So again, looking at the cover ratio is quite important. And generally within the investment space, I think a cover ratio of about 2 or more is usually considered to be like quite reliable. So that's something to look at. And then just more generally, look at the balance sheet of a firm. So look at its profits, look at its expected profits, look at its debt position. These are all, in general, these are really good things to do when you're investing. But these are kind of like key ways to spot reliable dividend paying firms.
And are we really talking about, old companies, potentially the bigger ones, not the smaller ones?
So this is a really interesting question. And I would say, generally speaking, it'll be older, more established firms that will tend to pay dividends. So, for example, like a newer firm, like a startup, especially like a tech startup, would be unlikely to pay any dividends at all to their shareholders. Oftentimes, because these are new companies that are focused on growth, they may be in debt to investors. From their point of view, it just wouldn't make sense for them to pay out a dividend. Most of whatever revenue they're making, they're plowing straight back into the company. So if you're investing in those type of companies, usually you're investing in them for capital growth because you think you're hoping that it's going to like double or triple in value over the next, let's say, 5-10 years, whatever. Whereas with an older, more established company, they'll have tended to be around a lot. They may not, they're not going to, or they're unlikely to double in size, let's say, in 2 or 5 years or whatever. these are the companies that will be more likely to pay out a dividend to their shareholders.
And can I just rewind for a second and
Mm.
get a quick explainer on what capital growth is and how that compares to?
Yeah, of course. So there are kind of obviously there are lots of different ways that you can invest, but a lot of people will either invest for capital growth or for passive income. So if you're investing for capital growth, you'll be buying into firms and funds that are very focused on growing the value of your investment. So you might be invested in, let's say, like an S&P 500 tracker, which would invest in lots of like American tech firms, let's say. And these will have a tendency to, they might grow very rapidly, let's say, and that's what you're banking on. You're hoping that the value of your investments is going to grow over time, and you're not necessarily expecting to get any like regular income stream out of it. Whereas if you're investing for passive income, you're interested in dividend payments. You're interested in firms that pay out big dividends. So with this investment strategy, you're looking at firms that are going to pay you like a regular income. So you're not leaving your money sat there to grow year on year on year. You're more interested in having your investment portfolio of dividend paying firms, and you want money every year. You want like let's say a monthly or a yearly income from those dividends. That would be the passive income approach.
Thank you. And can we just have a quick note on tax? Laith, we're talking about potentially investing in companies all over the world. Is the amount of tax you're going to be paying different depending on where the companies are based? Is that something that you should be considering?
Yeah, I mean, it is depending on how you invest, by the way, where you're investing directly in shares or via a fund and where you're investing. Also, I mean, simply tax as a subject matter, you should be concerned about in the context of income, because the UK government does tax you on your dividend income, and that has ramped up massively in the last 5 years or so. So the annual amount of dividends that you can now receive without paying any tax is just £500 a year, using this thing called the dividend allowance, which, when it was introduced almost a decade ago, was £5,000. So that's a very big change. So, the £500 worth of dividends, just to give you, some kind of measure of what value of shares you might hold. If you're getting a 5% yield, which is probably a little bit high, but just to make the maths easy, if you're getting a 5% yield, £500 is equivalent to a £10,000 investment in that company or fund. So you can see that very quickly, if you're building up money to deliver yourself an income from the stock market, you can start paying fairly hefty rates of tax on it, and that tax depends on whether you're a basic, higher rate or additional rate taxpayer. So if you're a basic rate taxpayer, anything above £500, you pay 8.75% tax on those dividends. If you're a higher rate taxpayer, you pay 33.75% tax on those dividends. And if you're an additional rate taxpayer, it's 39.35% tax on those dividends. I mean, the good news, such as it is that you can use an ISA to protect yourself from that tax to a large extent, because we have a very generous ISA allowance, which is £20,000 per individual each year. And once within that tax shelter, then you aren't subject to those rates of dividend tax, and so it's a very valuable resource for investors if you're looking for income. Actually, if you're looking for capital growth as well, because it protects you from capital gains tax. So using an ISA to hold your investments actually means that the income that's generated by them, more of it flows through to you rather than some of it being pecked off by the taxman.
And there's a lot to get your head around, especially if you're a beginner in this area. I mean, can we start to talk about, how you might get into it and how opting for a fund could be a way in?
Yeah, sure. I mean, I think we've talked a little bit about different ways that you might invest, and we've talked about investing in shares in the FTSE 100, which is a collection of shares. If you're going to go and invest in individual shares, so things like the ones Josh has mentioned, BP, Shell, HSBC, all these big companies, then there's quite a lot of work involved in that, because you have to go and research each individual company. You also need to run a diversified portfolio. And what I mean by that is not putting too many eggs in one basket. So you might really like HSBC. If you put all your money into it and it doesn't do very well, that's going to really hurt you. So the idea of diversification is you don't just hold HSBC, you hold other companies as well. And what is the number you might hold? Well, realistically, you should be holding around a minimum of 25 to achieve portfolio diversification. That's quite a lot of companies to research and keep an eye on. So actually, funds really help out with this because by investing in an income fund, what you're doing is you're already buying a pool of investments, a pool of businesses, a pool of stocks, which is managed for you by a professional investment manager. So those stocks are selected for you. What you have to do is select the fund. And again, you probably shouldn't just select one fund in case the fund manager doesn't do very well, but you could have a smaller number of funds. You could maybe have, if you're looking for income, maybe a portfolio of 5 funds. And that's easier to look after than a portfolio of, let's say, 25 stocks. Now you do pay a charge for that service. So if you're, investing in individual stocks, there are charges to pay, like stamp duty, commission on your trades, platform fees. For a managed fund, you also have the fee that you have to pay to the investment manager. Now, that varies depending on the fund, but it's typically around 0.8%. But as I say, what you get for that is diversification. You get an easier life, and you get someone who's a professional selecting the investments for you and changing them, of course, when they see fit. So definitely for a lot of people, I think an income fund is a good option. And the great thing about having that is if you're interested in the individual companies, if you're interested in choosing individual companies as well, you can own some funds and then add some companies around them. And that way you can build up your experience. And what you're doing is you've got your diversification through funds, but actually you can then start to look at individual companies that you like and add them to your portfolio. And because they're now still a small part of your overall portfolio, you don't have to worry too much about that diversification issue. Obviously, you need to balance how much you've got in funds and stocks, but it's an easy way to perhaps start to build up your experience, start to build up your knowledge, and actually invest in individual companies as well.
And so the first step then might be to choose a platform
Hmm.
to do your investing on. Do you want to give us an intro to the types of platforms we're talking about here?
Yeah, of course. So there are a whole range of different investment platforms, which, generally speaking, will give you a different range of options with what they offer to you as an investor. So the things to look out for when you're investing in through an when you're picking your investment platform, you want to look at the platform fees, which is how much they charge you to use their service. So platforms will generally either charge you a flat fee every year to use their service, or they'll charge you a percentage fee, which will be a percentage fee of all the investments, the value of all the investments that you hold with them. And you'll pay that fee every year. The other thing to look out for when you're choosing your investment platform is you want to know the range of options you'll be able to invest in through them. So, for example, some platforms will offer you, let's say, a handful of funds that you can invest into. They might also let you invest in, let's say, some bonds and some individual firms. They may not. Other investment platforms will let you invest in anything under the sun, whether that's funds, whether that's firms, whether that's bonds, whether that's exchange traded funds, all sorts, CFDs, all kinds of crazy things. So these are all things to bear in mind when you're deciding what platform you're going to use to hold your investments with. The other thing to bear in mind as well when choosing your platform is some of them will also offer you slightly different tools for tracking your investments. So generally speaking, most will have some kind of way of that you track your investments. Pretty much all of them will, but some of them might be a little bit better than others. So that's again another thing to do a bit of research around when you're choosing which platform you want to invest in. The other thing to look out for, which Laith has already mentioned, is fund fees. So fund fees, like Laith mentioned, they're annual fees that you pay, but they give you the peace of mind that you don't have to go and choose every single investment yourself. You've got this kind of ready-made basket of funds. Whereas on the other hand, if you were to invest into individual companies, a lot of platforms will charge you transaction fees. So every time you buy or sell a particular share in a company, you'd have to pay a transaction fee on that when you buy and sell it. Which, if you're someone who likes to do a lot of buying and selling, that can then end up racking up those fees. But there are some platforms that don't have any transaction fees whatsoever. So you may want, if you're someone who likes doing lots of buying and selling, you're maybe going to want an investment platform that doesn't charge you transaction fees. Similarly, an investment platform that charges a flat fee every year will tend to be better for investors who have a very large portfolio, because if they were to go for an investment platform that charges them a percentage fee on the value of their investments, if they have a lot of investments, like a large valuation, they will end up paying quite a lot in investment fees every year. So for someone with a very large valuation of portfolio, they're more likely to want like a platform that charges flat annual fees. Whereas if you're an investor who maybe you only have like a few £1,000s invested, percentage-based fees may make more sense for you.
And just to go back quickly to the point you made about investing for free,
Mm.
I mean, that sounds kind of too good to be true. In a nutshell, might one of these platforms be worth using?
So yeah, this is a really interesting question. We are starting to see the rise of these zero commission brokers, where these are essentially platforms that you can invest completely for free. There are no platform fees and there are no transaction fees. You'll still have to pay things like the stamp fees when you buy and sell shares. So there'll still be the stamp fee to pay. Obviously, taxes you'd still need to pay if you're investing outside of an ISA. And you'll still pay fund fees. So if you invest into a fund, you'll still pay the fund fee, but it's just the platform fee. There won't be a platform fee. And so this raises an interesting question of how are these platforms making their money? So I did a bit of digging into this, and I found that there are a few different ways that they make their money. Part of the reason they're able to charge no fees is because a lot of time they tend to be newer platforms that haven't been around as long. And so they tend to just have lower overhead costs than the more established platforms. They'll have like smaller number of staff. They may also have like a smaller range of options for you to invest in, although this isn't always the case. Another thing that they'll often do is if you hold money with a platform but it's not invested, let's say you put £5,000 into the platform but you haven't decided where you're going to invest it yet. That platform may hold those fees, and then any interest that's earned, they will keep the interest. That's another way that they can make money. And one other thing to point out is that some of these commission-free brokers will also offer investors the option of investing into what's known as high-risk investments. So these will be things like CFDs, contracts for difference, margin betting. These are all very high-risk investments that you have quite a high risk of losing money. And the way that, for example, CFDs and margin betting works, I believe, is you are essentially borrowing money from the platform and then betting that money on whether the value of a given asset is going to go up or down. This is very risky, and the platform will make money either way, whether you win or lose, basically. CFDs are quite interesting because they're actually banned in a lot of countries, but they are legal here for professional investors. Like platforms have to carry out certain checks on you before you're allowed to invest in them. But this is one way that some commission-free brokers will make money.
Well, you mentioned your recent article. We'll get a link to that in the description of today's show, as well as some other useful resources. I mean, we've covered a lot of ground today, but just before we wrap up, is there anything that we haven't mentioned or anything that we have and you'd just like to stress it again? Laith, do you want to come in first?
Sure. Yeah. I mean, we've talked a lot about individual shares and investing in shares via funds. One of the things that we haven't talked about in terms of income, which is a big part of the picture, is bonds. So these are basically loans that people make to companies and to governments. So, an example is you can lend money to the UK government. You buy what is called a gilt, a UK government bond. And these have become more attractive in recent years. If you look back 5 years, we had very low interest rates, and your typical, 10-year government bond, you'd lend money to the UK government at a rate of around 0.5%. That is now somewhere in the region of 4.5% that you will get back over a 10-year period. So these are quite an interesting area for investors to consider, as well as shares. They're less volatile than shares. And one of the joys of combining both shares and bonds is that they often move in opposite directions to each other. So what you find is if you invest in a mix of both, then what you get is is a smoother journey for your portfolio. So that might be something that's worth considering for people. You can invest in bonds directly or via bond funds. So in a similar way to shares and funds that invest in shares for you, you can invest directly in bonds, or actually just get an investment manager to do that for you. Or actually you can package the whole thing up in what's called a multi-asset fund, which might be attractive to some investors. That's a fund that invests in both shares, bonds, sometimes cash, property, other assets as well. And you can get those in a range of risk profiles depending on how much risk you want to take, potentially how much income you want as well. So I think that's probably worth mentioning. And just one final one for me is investment trusts as well. So investment trusts are kind of a little bit like funds, kind of a little bit like shares, but they're a diversified pool of shares that is run by a professional manager within a fund structure, basically. The slight difference with investment trusts compared to other funds is that the managers can, in good years of dividends, hold back dividends to pay out in bad years. And what that means is that they can generate a smoother income stream for investors, which is attractive to some people. Now, that doesn't mean they get more dividends. So if you're looking at a fund versus an investment trust that invest in the same things, they will receive the same amount of dividends. It's just that the income from one will be lumpier compared to the investment trust, which can smooth it out for you. So just another consideration, another potential tool for people to use.
Thank you, Laith. So much more to consider. I feel like this is a kind of endless topic. But just to finish us off then, Josh, what would you like to leave us with?
Yeah, I mean, I think just to build a little bit on what Laith said about investing in bonds, I think that goes really well with this idea of really diversifying your portfolio, which I think is really key. And bonds are a great way of improving the diversity of your portfolio. And when we say that, we really mean like holding different types of assets, holding assets from different industries, potentially from different parts of the world. And what this does is if the market goes through a period of volatility, you have some level of being insulated from it.
Well, thank you so much, Josh and Laith. It's been a really great episode. Thank you for joining us today.
No problem at all.
Thanks very much.